Have you ever opened a Forex chart and thought, what on earth am I looking at? All those lines, candles, colors, numbers can feel so overwhelming. But here's the truth. Once you understand how to read charts, you unlock the real language of the market. And today, I'm going to show you exactly how to read Forex charts like a pro, step by step. Even if you're a complete beginner, stick with me till the end, and I promise by the time we're done, charts will look no longer confusing. They'll start to literally tell a story. So let's get into this. Now, what exactly is a Forex chart? A Forex chart is just a visual representation of how a currency pair moves over time. That's literally what a Forex chart is. Okay, now instead of staring at endless numbers, we can see price movements as a picture that helps us or as traders decide when to buy, when to sell, and when to sit on our hands, literally. Now, there are three main types of charts. And on the screen here, I do have a few of them, as you can see on the screen. What you see on the screen is a candlestick. This is called a candlestick. We have the line chart, and this is the line chart. You can see beautiful lines, all right? Just a beautiful long line there, a zigzag line, right? And then we have the bar chart. Now, just something to take note of. When we talk about the line chart is really the simplest. Just showing, closing prices, good for beginners, but lacks real detail. Then the bar chart shows more detail, so open, high, low, and close. And then we have the candlestick, which is the most popular, okay, and my personal favorite also. So candlesticks show the same info as bars, but in a much clearer and more visual way. And what I have here is essentially just the candlestick. So you can see just where my cursor is on the screen, this is just a candlestick, okay? So you can see here, very large. So you have the green and then you have the dark ones. And that's just a candlestick, okay? Now, throughout this video, I'll focus on candlestick charts because if you can master candlesticks, you'll be able to read the market like a pro. Now, breaking down the candlestick chart, let's dive a little bit into this. Now, zooming into one of these candlesticks, each candlestick represents price movement within a specific time frame, okay? So if you're on the daily chart, each candle essentially is equivalent to 1 day. And now I'm just going to bring up the daily, so we just see what I mean by that. So let's have the daily chart here. So you can see here, let me go to today's date. So essentially you can see here where my cursor is. This is the 4th of September. That's the day when I'm recording this. And you can see this is the daily chart. And this entire candlestick, if you look at the right side where my cursor is also, you can see it's about the countdown. There's about 8 hours on this candlestick for this candlestick to close. So what this tells you essentially is that the daily chart, for a complete daily chart to be formed, you need 24 hours. Okay, and then we can go to other candlesticks. So whether it's the daily chart, the 4-hour chart, the 1-hour chart. So the 4-hour chart will require about 4 hours for the entire candle to be formed. The 1-hour chart will require 1 hour. So let me go to the 4-hour chart. So here we have the 4-hour. You can see here, each of these candles here will require about 4 hours for each of them to be formed. Now, this last candle we're on here, you can see if you look at where my cursor is just down, you can see the candle started around 11 a.m. And we have about 1 hour, 25 minutes, for the candle to close. That's about, that will make the entire 4 hours for that candle to form. And then we have the 1-hour chart. So the 1-hour chart also requires about 1 hour, for the candle to form. So right here, you can see on the screen here, I have all of these candles. Each of them, it takes about 1 hour for this candle to form. So that's essentially the candlestick. And then you can go down, to the 15 minutes, the 5 minutes, the 1 minute, and even seconds to see how those candles are represented there. Now, why is it important to understand this? It's very important to understand this because when you come on the chart and you look at the chart, it's foreign, especially if you're a newbie, right? But by the time you begin to see the story behind the chart, everything begins to come, literally together. When you look at a candlestick, you have, what we call the body. So we have the body here, that's the thick part of the candle. So if I draw something, let me draw something for us. So let's say this is a candle, and I'm going to shade this. Okay, so this is the body of the candle, right? So the thick part is the body of the candle. If I draw a line just above this area here, okay, and let me increase that a little bit and make that a solid line. Good. Okay, and I bring that also down here. Good. So this is the body of the candle, and then we have the wick of the candle. All right, so that's what essentially makes up a candlestick, right? So the body shows the opening and the closing price. So for a candlestick where you have, let's say for example, you know, the candle, let's say starts. Let me go to the 1 minute so I can show you something. So here we have the 1 minute candlestick. So you can see there's about 9 seconds for this candle to close. Now imagine, for example, you go to this candle started here, that's the open price, and let me just draw that. So the open price just here, that's here, okay, that's the open price. And now the candle just closed, and you can see here, just here, that's where we have the close. So we have the close here. Okay, so the candle opened here. It's a bearish candle, so it opened at the top and then closed below, right? So that's where it closed. And then the next candle just opened below here, and you can see it's going up, and it's going to close. If it goes up and you know the timer on the candle closes, that means it's going to close, you know, in the bullish direction. Okay, so that's just essentially it. And then as the candles go up and down, for example, this candle here registered a low here where you have this wick, but then pull back and then close around this area. Okay, and this candle, for example, you can see opened here low, and then it's going up. It's about closing in 2 seconds, 1 second, and then it's done. It is closed, so it closed higher. So that's a bullish candle. Okay, but you can see they all left wicks. So wicks are sort of, you know, the high, the low, and then, you know, the sort of space between the high and the closing price, or the high and the you know, the open price, and the low and the closing price, or the open price. That's essentially what you have there as wicks. Okay, so I hope with this anyways you sort of get a picture of you know, what makes a candlestick. So when you see it, you know essentially what makes a candlestick, right? Now that said, I would want to speak to the colors you have on the candlestick. So for example, what I have here on the screen, these are just the default candles, you know, that you find on TradingView. I'm using TradingView, by the way. If you don't know TradingView, I believe you'll find one of the videos on the channel where I actually talked about you know, TradingView, so you'll be able to understand what it's about. Now, but if the candle is green, essentially price closed higher than it opened, that means the buyers were stronger. If the candle is red or black, in some cases depending on the color, but the default color is really green and red. So if the candle is red, price closed lower than it opened. In other words, sellers were stronger. Okay, now think of candles as a battle between buyers and sellers. Every candle is like a mini story of who won that round. Okay, so when a candle closes red, it simply means that the sellers won the round. If it closes green, that simply means buyers won the round. Now let's look at time frames. Okay, now when we talk about time frames, like I said earlier, we have, you know, different time frames. We have the daily chart, we have the 4-hour chart, we have the 1 hour chart, 30 minutes, 15 minutes, 5 minutes, 1 hour. So we have various time frames. Now if you look at the chart I'm on here, this is the 15-minute chart time frame, and if you look at where my cursor is, just up here, this is the 50 minutes time frame. I have a few of them. So I have the 1 minute, the 5 minutes, the 30 minutes, 1 hour, 4 hour, and daily. So I've sort of selected some of them and added them to my favorite section so that I can always access them whenever I want them. But these essentially, you know, are the different time frames. Now these time frames help you to achieve different things, you know, depending on your analysis. If you want to learn how to maybe analyze, you know, your chart, you know, from a higher time frame, the daily chart, the 4 hour, and then you come down to the lower time frame, they just help you analysis. Okay, and hopefully we'll look at that, you know, in another video. But now when we talk about time frames, charts essentially can look totally different depending on what time frame you're viewing. Okay, so 1 minute or 5 minute charts, they're usually great for scalpers. You know, this literally just show you tiny moves. Then 1 hour chart, you know, are good for swing traders, you know, more reliable signals. In other words, you can stay on them, you know, for a longer time. If you enter a trade, that means you likely be in the trade for a longer time. Then we have the daily and the weekly chart. So the daily and the weekly charts usually show you the bigger picture, that is long-term trends. For example, if I go here and I go to the daily, you would see that the gold, because this chart I'm on is go for gold, you can see gold has been bullish since from about the 20th of August. We've had mostly green candles. In other words, gold has been closing bullish, since from the 20th of August, right? It has been bullish. Okay, so the higher time frame gives you a bigger picture. So for a trader, if you're able to understand what the higher time frame is, it helps you to understand the major bias of the market. So they show you the bigger picture and the long-term trend. Now, this is approach tip I'm going to leave you with. Always analyze multiple time frames. The higher time frame gives you context, the lower time frame gives you your entry signals. Okay, so for example, you might see an uptrend on the daily chart, but find your entry on the 1 hour chart. Okay, and these time frames all speak different things. So if you're able to analyze multiple charts, you'll likely always be on the right side of the market. Now let's look at price action. Let's read what the chart is actually telling us. Trends. Now, trend is a market going up, down, or sideways. Okay, uptrend simply means higher highs and higher lows. And let me just show you what that is exactly on the chart. So yeah, I have this tool. So when we see an uptrend, this is an uptrend. Okay, higher highs and higher lows. Okay, so that's an uptrend. So you can see all the higher highs here. This high. Okay, we have another one here higher than the former one, right? And then this one higher than the former one. Okay, so higher highs and then higher lows. We have this low here. Okay, and then we have this higher low. Okay, higher than this one, and then another higher low. Okay, higher than the previous one. So this essentially is an uptrend. Okay, so higher highs and then higher lows. Now when we talk about downtrend, what are downtrends? Downtrends, just simply refer to lower highs and then lower lows. An example: lower highs, lower lows, like this. You see that? That's it. So lower highs, high, this is lower than this high is lower than this high is lower than this, and then lower lows. This low is lower than the previous one, this low is lower than the previous one, and then this low is lower than the previous one, and then it goes on like that. Okay, so that's a downtrend. Now how about sideways? When we say the trend is sideways, or when we have something called consolidation, this is what it's going to look like this, neither going up or going down. Okay, so this is a consolidation range. In this situation, we say the market is trending sideways. It's literally just consolidating. Now let's look at something called supply and demand, or in some cases, some persons refer to this as support and resistance. Now these are levels where price tends to bounce. Okay, and if I just go back to my gold chart here. Okay, so if I go back to my gold chart here, when we talk about supply and demand, levels where price tends to bounce, look at this area here. If you look at, okay, you can see this line I just added there. You can see that price initially came there and bounced from there, and then broke out, returned there, and then now it's reversing. So what do you expect now from this? We expect that hopefully this will register a new high, right? So supply and demand, or support and resistance, to me, they're just different parts of the same coin. It's just English, different words to describe mostly the same thing. So a demand or a support is simply just a floor price. A floor price struggles to go below. Okay, so price is struggling to go below this, so that essentially becomes our support. And then the supply or the resistance is a ceiling price, this where price is a ceiling where price struggles to break above. So it's a resistance, and it's a supply essentially. Now, chart patterns. What are chart patterns? Now, when you zoom out, price often forms patterns. Okay, so look at this. You can see this. Now we have a lot of patterns here in the market. I can draw this. Up, down, you can see it up, down. So these are all patterns in the market. So you don't need anybody to tell you that this market is an uptrending market. This is as clear as day, right? So the market is an uptrending market. So we may get a reversal, but it's largely an uptrending market. Okay, so this is essentially what we mean by chart patterns. Now There are different types of, patterns that people look for in trading. Some, look for double tops, double bottoms, liquidity sweeps, inducements, and all of that. I wouldn't be going into the detail of that, but just to get the basic understanding that there are so many patterns in the market that people look out for, and we're going to be seeing that, in subsequent videos, on the channel. Now, there are so many patterns. The common denominator is that these patterns, help us to predict possible future price moves. That is just essentially it, and that's why we look at these patterns. Now, let's look at indicators and what indicators mean when we talk about trading. Now, I know you've probably seen traders with 20 indicators on the charts, a lot of indicators. If you look at where my cursor is right now, there's so many indicators I can add to the chart, and essentially they will all show up. You must have seen a lot of indicators, from moving averages to different things. Indicators, they essentially just do different things in the market. Now, it's very important to understand that indicators are good, but if you overuse them, it also becomes a problem. Okay, so my advice is this: keep it simple. Learn to read price action first, okay, and only use indicators to add some confluences to price action. This is very important. Learn to read price action, because price action is king, as they say. When you learn to read price action, you can now sparingly use indicators just to add, some sort of flavor to whatever it is that you do in the market. So, but don't start by relying on indicators. Most of the indicators, as a matter of fact, are actually lagging indicators. Okay. Now, also remember the indicators are like assistants, not bosses. This is very important. Always read price action first, then let indicators confirm. When you understand price action, you understand the structure of the market, you understand the bias of the market, the indicators can then come in to confirm. Okay, now let's put everything together. Now, start by identifying the trend. That is the first thing. If you can find the trend of the market, then I would say 60% there, because then you will not take a trade against the major trend of the market. So you have to start by identifying the trend of the market. Now, for gold, you can see here that we clearly have seen that gold is bullish, okay, on this 15-minute chart based on what we've seen. So we know that if we go bullish, most of the time we're going to be right. So start by identifying the trend. Then the second thing you need to do is mark out the demand and supply, or support and resistance. Okay, so you mark that out in the market, so okay, the market has tried to break this level, but it failed to break that level. When the market comes out to that level, you definitely know that the market will likely react, when it approaches that level. So you mark out all of those areas in the, on the chart, and then the third thing you need to do is that you watch candlesticks, okay, for clues of reversals and continuation. So the candlesticks themselves, contain a lot of clues. They give a lot of clues as to what the market will likely do. So you want to also make sure that you watch those to ensure that you have all of the information, you need to make a decision, right? Then you also use indicators for confirmation if you want to use indicators, okay? But remember, price action is king. Learn how to read price first, then indicators you use sparingly. Now, when you approach charts this way, instead of feeling lost, you feel in control. You'll see opportunities and know when to wait. All right. Now, with all of this that we've just looked at, I want to say congratulations. You now know how to read Forex charts like a pro, just with these little tips. Now, from candlesticks to trends, supply and demand, support and resistance, you've just taken a huge step, towards trading with confidence. Now, if this video helped you, make sure you subscribe, because I've got more tutorials coming your way. And if you want to go deeper and take your trading journey seriously, don't forget to check out ParutoCapital 360 trading program on our website, ParutoCapital.com. You see it in the description, or somewhere in the screen. Now, inside you get structured lessons, tools, and also mentorship to help you grow, into the kind of trader you want to be. So keep practicing, keep learning, and also remember that trading is a marathon. It is not a sprint. Okay, so with that, I want to say thank you for watching and see you in the next video. Bye bye. Cheers.